I'm sitting here with Phil Dushey, CEO of Global Financial Training Program, and we're talking about topics that relate to helping small businesses finance their growth. One of those topics that seems to be very misunderstood is accounts receivable financing. Many small businesses do not realize that the business that they write can be financed. They're always rushing from invoice to invoice to try to keep up with their cash flow. Can you tell us a little something about that, Phil?
If we turn back the clock to 2007, 2008, when the economy was really booming, let's say you were in the business of shipping a product. Let's just say you sold coats, you sold pants, you sold groceries, you sold anything. Or you provided a service. And you provide your service, or you shipped out a product, and you sent out an invoice and you're waiting to get paid. Well, normally payment terms would you get your money in 30, maybe 45 days at the latest. Since this economic crisis has set in, now the new normal for paying bills is 60 to 90 days. So in your business, if you're waiting 2 to 3 months to receive your money, that's going to put a real strain on the cash flow of your business. Your rent has to be paid every month. Payroll has to come in every single week. Maybe you have to buy merchandise to replenish your inventories in your business. Maybe you have to do special marketing, whatever it may be. So you're going to get paid, but you can't afford to wait 2 to 3 months to get paid. So we have a way of providing a steady cash flow to business owners that a lot of them don't even know even exists, where we can take those invoices that they have. Invoices are probably the best collateral in the world, and we can provide funding for their business through them. Now, here's how it works. Let's say, for instance, right now, we took a $10,000 invoice. Let's take an example, one invoice. Although what we do is we don't only finance one invoice, we finance all the invoices of the company. Now, we would take and advance that company, let's say 85% of that invoice, the day they send the invoice out. So that would be $8,500. Now, we still owe the company $1,500. Now, let's say 60 days later, that invoice is paid, the $10,000. We would send the balance of the $1,500 to the client, less whatever the interest charges were for the time that money was outstanding. So this gives the business owner steady cash flow where they can pay their bills each month, pay their payroll each week. They can grow their business as much as they want all the time, and they're never in a cash flow negative position at any given time. Now, the banks do this as well. It's probably one of the most requested types of financing as well. But in order to get financed by the bank, well, you better be in business at least 5 or 6 years, or longer in some cases. You better be profitable for 3 to 4 years. You better have impeccable personal credit. You better have great business assets. You better have positive net worth in the company, and they should have great personal assets as well. Well, not a lot of businesses fill that bill of what they do. We can finance a company that's a startup. Banks won't do that. We can finance a company that's in business 6 months, a year, 2 years. I don't care if the personal credit of the principal of companies are 400 and 800 because it really doesn't matter. I don't care if they're profitable, they're not profitable. It really doesn't matter. Now, you might say that, well, that sounds crazy. Well, it's the way you look at it. See, the banks are looking at the company that they're financing. We look at the people they're selling. We expect the people they're selling to pay their bills. That's what we're basing our credit on. So if we believe they're going to pay their bills, then we're going to approve that account. That's the biggest difference between us and a bank. We can also approve them in 24 to 48 hours and get them funded within a week, where it's going to take a normal typical bank 30 to 60 days to approve a line of credit for them. Yeah, our pricing might be a little bit higher than a bank, but not as much as you might think. But we can get them immediate funding. And again, most businesses don't know that this is available for them. They think they have to wait 2 or 3 or 4 or 5 years before that's available. But we're able to get that done right away. And it's commonly called, what I'm saying, factoring. It might be a term. A lot of people have heard the term. Most people don't know what that term means. Factoring is a household word in the European countries, but most of the banks do over there. It's catching on very, very big here, where, again, we're approving credit based upon who they're selling to and not so much who they are. So we can get them approved 1, 2, 3. You can be a startup company and get approved. That's what accounts receivable financing is all about in a nutshell.
So let me ask you this question. I have, as you know, been in many businesses, and there's always that situation where you're facing great opportunity.
Yep.
Macy's comes in and you know, you've been selling to mom and pops
Yep.
for the last 5 or 10 years, and suddenly, you know, Macy's loves the idea that, you know, you've got FUBU, and you're going to be able to sell an awful lot of goods to Macy's. There's only one problem. You have to make the goods. So they're going to give you a purchase order. But if you don't deliver those goods, you will never sell to them again. Is that a typical scenario for accounts receivable, or is that a scenario for a different type of loan?
Well, it's even worse than that. If you don't produce that goods and ship it on time, they can cancel that order, and you're stuck with whatever you have. So it's even more serious of a problem. What you're talking about is something called purchase order financing, and we're doing a lot of it right now. It's where a company is in a business doing a certain amount of dollar volume, and all of a sudden they get large orders, and they don't have the money to produce those orders. And that's called purchase order financing. So let's say a company like Macy's issues a purchase order. Now, this so everybody understands what a purchase order means. It's also called an irrevocable purchase order, which means the order is placed, and if you ship that on time, Macy's cannot cancel that order. The only way they can cancel that order is if, in fact, you don't ship on time, or you don't ship the proper product on time, because they know you have to go and make that product and arrange for the financing of that product. So let's say, for instance, now you're going to produce, I'm just going to make it up. Well, let me give you a real-life example, okay, with some Macy's. I'd say about 5 or 6 years ago, everybody knows the power of Oprah Winfrey, and unsolicited, she came up on her show, and she was wearing these jeans. They were like the slimming jeans. And she says, "I love these jeans. Don't I look great?" And I bought them in all 8 colors. Well, the manufacturer didn't know it was coming. Okay? She meant it from the heart. Well, all of a sudden, 2 weeks later, she had $15 million worth of orders on her desk, and she didn't know what to do.
To clarify one point, you said that she had these orders and she suddenly was faced with this problem. I assume what you're speaking about when you say she, you mean the manufacturer, not Oprah Winfrey.
No, the manufacturer was a woman, yes. They were used to doing about $6 or $7 million a year. And they were recommended to our company, and they needed a fast $8 million, okay? And they had purchase orders from stores like Macy's, Neiman Marcus, okay, Bloomingdale's, and within 4 days, we were able to provide her the funds in order to make those jeans. They were made domestically right here in the United States. So she was able to meet all those shipments. But in order to do purchase order financing, you need to also have an accounts receivable line of credit in place as well. Not to make it overcomplicated, is that they're almost 2 separate lenders, although we combine them into one lender. So once I lend you the money for the purchase or to produce the merchandise, then once you ship it, Now you can get an advance on the invoice, and from that advance, the purchase order money is paid off. So we do this all day long. Very, 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 very common. And it's more and more and more every day now. It's really something that's happening big now, right now.
Thanks. Okay. Well, I thank you so much for clarifying that, and let's speak again soon. Thank you.